Hello students, I am Professor Dr. Jyotindra Jani and welcome to my YouTube channel for the subject income tax. Let us start practical problem of the chapter income from house property. First of all, let us remember the important points or the steps to be followed for the calculation of the gross annual value, net annual value, and the income from the house property. In all the example, the very first step is to have the calculation of the gross annual value. And the gross annual value is calculated on the basis of the municipal valuation, fair rent, and actual rent received or receivable. You will be very well be aware of the calculation whenever with the practical question the solution you will have in front of you. Then after having calculated the tax gross annual value, we have to deduct the local or the municipal taxes from the gross annual value, and if it is paid by the landlord, then resultant figure so arrived means after deducting municipal taxes from the gross annual value is the net annual value of the house property. Thereafter, from the net annual value, we have to provide standard as well as the specific deduction. The standard deduction is the 30% of the net annual value for repair and collection charges, irrespective of the actual expenditure incurred, and even if the instruction is not given, but the standard 30% is to be provided as the deduction from the net annual value for the repair and collection charges. And then after, if we have borrowed a loan for the repairing, renovation, or the construction of the house, then interest on loan is also to be deducted from the net annual value. And thereafter, the resultant figure so arrived is to be considered as the taxable income from the house property. For the solution to a problem, a statement is required to prepare containing all the required information, and here is the format of the statement. On the left hand side at the top of the table, there is the ordinary resident, means the status of an individual SSC need to be recorded. Then on the right hand side of the statement, the assessment year 24-25 and the previous year 23-24 is to be recorded. Then we have the total three columns, of which the first one is a particular and the two columns are for the amount rupees. We have to start the solution with the gross annual value, and the value is to be recorded in the outer, like second column. And from the gross annual value, we have to deduct local or the municipal taxes paid by the owner. Resultant figure so arrived is to be considered as the net annual value of the house property. Then we have a specific and standard deduction, which is already discussed, 30% of the net annual value for repair and collection charges, and as well as the interest on loan. Both these amount first is recorded here in the first column, and then after it is to be recorded at the outer column is the total of both the amount, and then the resultant figure so arrived is to be considered as the taxable income from on the house property. Student, let us start with the very first question. First, I am reading the entire question. Mr. Anshul has let out his house property to a tenant on a monthly rent of rupees 8,000. The tenant vacated the house on 31st of December 2023. Immediately it was let out to a new tenant on a monthly rent of rupees 7,200. During the previous year 23-24, the SSC has paid municipal taxes like this of the previous year 23-24 rupees 9,000 and of the previous year 22-23 rupees 9,000. Remember, it is already instructed that both the amount of the taxes is paid during the previous year. Remember this and find out the net annual value for the assessment year 24-25. Now, let us see the answer to the question number 1. Now, in this example, the property is let out at rupees 8,000 per month till 31st of December 2023, and thereafter it has been let out at rupees 7,200 per month. For the computation of the taxable income from the house property, higher amount of the rent must be taken into account. So, for the whole year, we will take into account 8,000 per month, though it has been let out from the 1st of January at rupees 7,200 per month. And remember that only the net annual value is to be calculated for this answer. So first we have to calculate the gross annual value, and remember the gross annual value is to be calculated on the basis of the expected rent or the annual rent received or receivable, whichever higher. So very first step is to have the calculation of the expected rent, where municipal valuation or the fair rent higher amount is of our expected rent. But in this question, municipal value as well as the fair rent is not at all given to us. Therefore, step number 1, expected rent is nil. Or this is compared with the step number 2, annual rent received or receivable. As I have already told you that we have to consider higher amount of the rent, which is 8,000 per month. Therefore, the annual rent is of rupees 96,000, and the higher of the step 1 or the step 2 is the gross annual value. Hence, the gross annual value is of rupees 96,000. Before we prepare the statement, remember the important provision that so far as of the municipal taxes are concerned, if it is paid by the owner, only then is to be deducted from the gross annual value. It means that if it is outstanding or paid by the tenant, then it cannot be deducted. And municipal taxes of whichever the year, but if is paid during the previous year, only then it must be deducted. Remember this, it is applicable for all the questions. This is the provision for the municipal tax. Let us now calculate the net annual value by preparing a statement. The ordinary resident here is of the left hand side. The statement shows the net annual value. On the right hand side, the assessment year 24-25 and the previous year we have is of 23-24. Both the years are to be recorded on the right hand side but at the top of the table as well as of the permanent account number. Now, this is the statement where the gross annual value as it is calculated 96,000 less local or the municipal taxes paid by the owner of the year 23-24 9,000 and of the year 22-23 9,000. Therefore, the total amount is of rupees 18,000. Deducting these 18,000 from the gross annual value 96,000. Resultant figure so arrived is of 78,000. This is the net annual value of the house property. Question number 2. Here is the instruction. The annual municipal value rupees 56,000, fair rent rupees 63,000, standard rent rupees 66,000, and the rent receivable per month rupees 6,000 relate to a let out house. Municipal tax is 5%, vacancy period is 1 month, the unrealized rent is 6,000. Find out the net annual value of the house. In this question, we have the point to remember, and the point are as such. Here we have the information in this example of the municipal valuation, fair rent, standard rent, rent receivable, municipal tax at 5%, vacancy period is 1 month, and unrealized rent is 6,000. Let us calculate the very first step of the gross annual value, and it is expected rent. Remember, the expected rent is nothing but the higher of the municipal valuation and the fair rent. Municipal valuation over here is 56,000 and fair rent is 63,000. Therefore, the higher value is 63,000. So, this is the expected rent. But in this example, together with the expected rent, the standard rent also is given, which amounts to rupees 66,000. Remember, when standard rent is given, the actual expected rent is to be taken as lower of the expected rent and the standard rent. So, actual expected rent now is of rupees 63,000. This is now compared with the annual rent received or receivable. Monthly rent is given to us, which is 6,000 and is multiplied with 12 months. Therefore, the annual rent is of rupees 72,000. In this example, the unrealized rent also is given, and the unrealized rent means the amount of rent not paid by the tenant. There is an effort for the collection of the rent. The tenant vacated the house property without paying the rent, and even after the efforts, when the rent is not received, then it is considered as unrealized rent. Unrealized rent is a loss for the landlord, hence it must be deducted from the annual rent received or receivable. Therefore, the annual rent comes to rupees 66,000 after deducting unrealized rent from the annual rent received or receivable. Now, step 3. Higher of the step 1 and 2 is the base for of the GAV. So, base for of the GAV is of rupees 66,000. Here, the vacancy period also is given, which is 1 month. And before we arrive at the final GAV, loss due to vacancy is to be deducted, which amounts to rupees 6,000. So, final GAV is of rupees 60,000. Let us now calculate net annual value. As usual, the statement is to be prepared. On the left hand side at the top of the statement, the residential status of an individual at SSE. At the center, the statement shows net annual value. On the right hand side at the top, assessment year 24-25, previous year 23-24, permanent account number, and in the table the starting point of the solution is the gross annual value which we have calculated 60,000 less municipal tax which is 5% of the municipal valuation 2800, and finally the answer net annual value is 57,200. Thank you very much.